Good morning. You're watching the market right here in ET Now, day after the budget, and we are back right here in the ET Now studios. Well, yesterday it was a very, very lackluster move for the market. It's back to business really. The budget seems behind us. Yesterday as well, you did not see any meaningful price action from the index per se. It was all about individual stocks, which of course we'll talk about in just a short while from now. But I guess in sight now is the previous high, Nikunj, 22,124. Are we going to clock that anytime soon or not? Because the Nifty implied open is already suggesting us getting very close to 21,900.
You know, I mean, budget used to have a lingering impact for weeks and months. Then it became like a impact which lasted for a couple of days. And yesterday's budget impact actually lasted for just 60 minutes. As long as the speech was on. So speech was 60 minutes and the impact was 60 minutes. So that is what it was. I mean, look, the budget was a simple budget to understand, high on confidence, big on promise, and it really maintains a momentum towards keeping the economic momentum going. So I think it's a budget which, in a sense, will just keep the outlook and the economic momentum strong. But what happened on the budget day? Now that is important. Volatility remained low. India VIX corrected by about 10%, and foreign institutional investors, they built up long positions. Given that we've got a decent global setup also, US markets are in a good shape, crude is behaving itself, last night meta numbers were strong. Now that the event risk is behind us, whatever concerns, whatever yes, no's were there in the system, are we on course to make a new high, a decisive new high, and then really, branch out in what really could be called as the pre-election patch for the market. So the budget is over. Now optically market will move from pre-budget and the budget day action to the pre-election mood, and that is how the market setup is. FNO snapshot, Nifty futures trading at a 43-point premium. The long positions are there, retail long and FI long. So I will not be surprised that we make a new high and we perhaps take it from there. This frankly has been a good week because the small and the mid cap stocks have also done their bit. So, while individual stocks are important, the tone and the tonality is that the market, the sleepy bulls are ready to perhaps gallop again.
Yeah, you've practically lost your voice, Nikunj, with all the talking yesterday. I think
you have to take over today. You both have to take over today.
You can't wait for the weekend. But you have a few hours more to go, unfortunately. But yeah, here's how brokerages have described the budget, really. For instance, CLSA, just going to read the headlines. They say it's a judicious budget with key focus areas on affordable housing, railways and research. BofA calls it prudence trumping populism. That's how they're describing the budget in their latest note. And Jefferies puts it as doing the right things with tighter fiscal, jump in capex, and all of the government priorities being what everyone wanted. So yes, they've got some additions, Jefferies, to their model portfolio. They've hiked their overweight stance to L&T. They've got key additions like KEI, lower weightage to TVS Motor, Eicher, Kataria, and NTPC. But basically, Nikunj, even the kind of tone that we're getting from all of the brokerages on the budget is that they have done the right thing, with fiscal discipline being the center.
See, what is normally the concern ahead of all budgets, which are the last budget before a new election cycle?
Yeah.
That something populist would be done. And there was just no mention of any kind of a large scheme, anything which was very popular. Now, that's a big departure in the thought process.
Yeah. But maybe that could take place in July. Perhaps not prior to, but post.
You would want to come up with a populist measure ahead of the election cycle. That's how it would move, right? That's how historically it's been. So markets were expecting something on that front. That, in a sense, has concern, in a sense, has not translated into reality. Second, fiscal deficit coming down. Well, I think that is something what you want. Fiscal deficit comes down. And if government is confident of bringing fiscal deficit coming down, that means they're expecting the economic momentum to really stay strong. And see what it means for the macro, the bond market and the currency market. So for me, the budget this time is a clear endorsement of the fact that we are in a macro stable regime. Inflation is moderating now. And if nothing goes wrong globally, the 2020 the second half of this year of FY25 could be another good year. And that explains why the bond yield actually went higher. That explains that why markets yesterday saw uptick in terms of the currency market and also what we saw in the banking space. So if you're frankly asking me for a trade which now opens up post-budget, I think large PSU banks, beneficiaries of rupee appreciation, not depreciation, importers largely. And third, you actually would see indirect impact which will start kicking in consumer discretionary as interest rates will not go higher. So if you ask me that is there a bigger hint for the equity market or the bond market, I think the bigger hint and the bigger winner this time actually is the bond market, the factors I just mentioned.
Yeah, absolutely. But it's back to business as it was yesterday itself, and it's back to really tracking earnings. Today, you've got some important ones, and especially yesterday, Nikunj, with the thrust on tourism, the mention of that in the budget. And, you know, most of our experts, I recall Vijay Kedia, that was his top idea, right? Interglobe Aviation, that reports its numbers, and of course, Tata Motors.
I mean, the Simpson yesterday gave out some brilliant names. I never thought that the Simpson would have actually that exciting names.
Yeah.
Okay, so are we talking numbers? Are we talking budget?
We're talking numbers.
We're talking
Tata
numbers,
Motors, Interglobe Aviation, and UPL today.
Okay, so UPL has been a disappointing number.
Yeah.
Markets frankly have, I mean, I'm not saying they've given up on the stock, but markets in a sense have not been very happy with what's happened on the demand front, on the debt front. So it's just been a very dry and a rough patch for UPL. I mean, when markets have gone through the roof, and look at UPL down 25% in the last 52 weeks. That's serious underperformance in my book, one. Second, let's look at the Tata Motors. Now, this is where expectations are not high, but they're really, really, really high because the stock's been in marked outperformer. Are we at that turn for Tata Motors where suddenly they will say that, okay, EV is now becoming a very, very prominent place for them and the commitment towards, cash flow listing, it continues. I get a sense that Tata Motors will just not stop at one subsidiary listing. I think there could be many more coming and there really could be a hint to that. So margins are important, EV commentary is important, and any hint whatsoever as to post Tata Tech if anything goes in terms of the listing per se. The stock is up 97%, guys. So please remember that that is something which is a very large factor in terms of positioning of the stock per se. So that's about it, Aisha. I think Tata Motors from a large standpoint is the big number to watch.
Yeah, absolutely. Tata Motors, and that's going to have a bearing on which way this mighty one from within the auto pack moves. Kunal, Naresh are back with us to talk about what the market structure is, done and dusted with the budget. It's back to business and back to, trading, I guess, as well. Naresh, hi, morning. Kunal, Naresh, if I could come to you, didn't really see any meaningful move on the index per se. But now everyone's talking about whether or not we're going to retest that all-time peak once again on the index. Do you see that happening?
So I would consider it to be a very high possibility. We go and test those new all-time highs. If you look at it globally, we are hitting new all-time highs on various indices. Yesterday, we saw a good uptake across the world as well. And if you look at the structure on the Nifty, we've started seeing Reliance take leadership. Then you have SBI, which has come very close to new all-time highs. We've seen a small recovery in HDFC Bank. We have not seen any major selling pressure in HDFC Kotak Bank as such. Then you have auto stocks continuing to make new all-time highs. So the leadership is there. So overall, structurally, the setup is there for a move towards that 22,200, 22,500 mark. And for now, 21,400 becomes a support level, and that becomes a trailing stop loss. So the view remains positive. And if you look at all the other indices, small cap and mid cap have already hit new all-time highs. So the benchmark has been lagging because of a few heavyweights. But I think we should be testing those levels soon.
Kunal, morning. It was all about autos yesterday, right? I mean, of course, a little bit nudge from HDFC Bank. That we'll discuss later. But Maruti, Tata Motors, Eicher, it was all the auto names. You think that trend is going to continue today too?
Well, I strongly believe so. In fact, what we've seen is a classic base formation for many of these auto names. For example, Eicher Motors was one of the stocks which was beaten down over the last 1 month. The stock fell, I think, more than 10% in the last 1 month, corrected towards 3,750, 800 levels. And slowly and steadily, the stock, after spending a lot of time at the 3,750 odd mark, has managed to make a comeback. There was almost a 200-point jump to the stock in the last 2 weeks post the price correction for Eicher Motors. Maruti, I think, has been a classical case. The stock has shown classical signs of bottoming out. So, at one point of time, the stock had come closer to the 200-day moving average, retested the 97.50 to 55 mark on the spot levels. But I think after yesterday's move, the stock has managed to give a lot of strong confirmation signs, a breakout of a 50 DMA, breakout of swing patterns, breakout of a trend line resistance for Maruti. So that also augurs very well. And we've already seen Tata Motors, Hero MotoCorp, Bajaj Auto doing exceptionally well for themselves. Even the likes of TVS Motors has been a lot more consistent in terms of the price pattern. So I think the only one which was lagging behind in terms of momentum was Maruti as well as Eicher Motors. These stocks have made a comeback.
Okay, let's find out Naresh's stock-specific strategies too and what exactly he is betting on. Naresh?
So first is the buy on Naukri, InfoEdge. Now that's a stock which break out above the 4,900, 5,000 mark, went up a bit, and now has retested those levels for the last almost 2 weeks. So a very similar breakout to what happened with the rest of the new age companies, wherein we've seen PB Fintech make a base, Zomato make a base, and this remains the larger one in that trade. So out there expecting a move back to new 52-week highs and a test of 5,500 to 6,000 in the short term. A good risk reward buy here with a stop loss at 4,900. Second is a buy on Maruti. This has tested the 10,000 mark, which was the high in 2017-18 as well as in 2022-23. The retest is done, and finally the stock has given an uptick and a strong recovery from those support levels. Now it expected to take a leadership in the auto pack. Expect a move towards 11,500, stop loss at 10,200.
There you have it. Those are Naresh's top bets. And Kunal, I was just going to ask you, do you also have Maruti in your list? And yes, indeed, you have.
Well, yes, Maruti turns out to be now a classical case of a possible turnaround, at least in terms of the charts. So I'm expecting new highs to be tested for the stock in the very near term. So 11,400 is where I would place targets for Maruti, and stop loss could be kept at 10,300. And Canfin Homes is the other stock which is coming back into a double bottom breakout as well as a swing pattern breakout on the charts. The stock closed almost at 795, 800 levels. So in touching distance of breaking below the psychological 800 mark, would suggest a buy with 850 as a target, stop loss at 755.
Okay, let's now throw focus on what are the individual stocks which are going to be in focus. Firstly, I want to pull out the soundbite from Paytm, Vijay Shekhar Sharma, the CEO, talking about it in his conference call just yesterday, saying that day after RBI restricted Paytm operations, he's saying that central bank's order is more of a speed bump. Let's hear out exactly what he told shareholders as well as the media.
I think it is a bit of both. There's no doubt about it that the very nature that payment business is significantly carried by parent, Paytm, in this situation, as you just heard us talking about it. So bank did have dependency on Paytm for some of the payments offerings like wallet, etc. And we were able to deliver a lot of comfort, but it seems like, which is the second part that you're asking, that they were not completely comfortable.
What a whack, Anisha, in trade, 20%, didn't budge from there. You think after hearing the commentary of the management, there could be any change?
No, I don't think there'll be any budging around today as well. And yesterday, it was a very strong circuit that we had seen. There were just sell orders all the way down to almost 450, 500 rupees as well. A lot of selling pressure and clearly no buyers on street. So I'm expecting probably another circuit or at least a very sharp downtick to begin the trading session with. There have been downgrades across the board from brokerages as well, because there was a lot of confidence that came post the call as well. The question regarding why it happened is still unanswered. They are saying that they haven't received any communication from RBI, and they too were caught by a bit of a surprise by this kind of move. They're very confident that they will be able to partner with other payments bank and get things working in a couple of weeks itself, and it will be back to normalcy in the month of March itself. But the street is a bit worried as to what will be the future, and will there further steps be taken by RBI. But talking about brokerages, JP Morgan has downgraded the stock. They're talking about a target price of 600 rupees. They'll have to migrate their business to other banks, and that will dilute the economics and the network effect. So that's the other thing to watch out for. They say that they don't believe that the order is an end of the road for Paytm, but it materially impacts the growth in the near term. There's another downgrade that has come in from Axis Capital, and they've cut the target price all the way to 450 rupees now. Of course, it's sell coming in from them. They're talking about how disruptions are at 3 levels. Of course, there'll be operational challenges when they'll have to move to the nodal accounts. There'll also be a shift in terms of the merchant QRs as well, and there would be heightened competitive intensity, which others would like to take this opportunity and eat into their market share, and all of this will disrupt their business. So clearly, Nikunj, it's not like a small obstacle on the road, but it seems like they'll have to take a bit of a detour on the road to profitability now.
See, the crux of the business model has changed, right? And if the crux of the business model has to change, they don't have to take a detour. They will have to reimagine themselves. And that reimagination will come at a cost. It will come at a cost of, what will happen to, it will come at a cost of revenue. It will come at a cost of operating cost, and it will also come at a cost of time when they'll have to come up with the new architecture. Look, this is not the end of the road for Paytm. I'm sure they will come out. But what the assumptions were as to where the franchise was moving, how the payment business is going to move, how the wallet business was evolving, what will happen to the insurance business, all that changes. Paytm was not cheap. Even at the current market cap, just look at the market cap. I mean, the market cap for Paytm is not very cheap. See, there are a lot of folks who bought actually into Paytm because of hope trade. Okay, the fintech space is improving, Paytm is improving, it's a market leader, it's a great brand. A lot of those sort of weak hands which bought into Paytm after the recent rise, they would be tempted now to get out. And then there is continuous supply which keeps on coming from anchor investor. So I'm not saying it's the end of the road, but the point we just want to bring out for our viewers is that there is going to be more supply than demand in the near term, and you should not be tempted to buy Paytm even if it goes down 25 or 30% from here. It is better to buy Paytm when you get clarity as to how are they likely to re-architecture themselves, and also ask yourself this very big question. While Paytm may be coming out, Anisha, and saying that, look, we don't know why, the regulator does nothing without a why. There must be a backstory which we are not aware of, or maybe Reserve Bank of India does not want to share, but there is never a why when it comes to a regulatory regime, because if regulator has given you permission to do it, there is a check and balance and a framework which you have to bring, and if you're not following it, then it's a cross. So I want to know the why before I decide what is next for Paytm, and for me that is a bit of a sandook right now, which I don't have the digital lock key for.
Yeah, and brokerages have clearly downgraded that. JP Morgan downgrading it to underweight, Axis Cap as well to sell, cutting the target price to 450. Well, from bad news to fairly good news, it's Indian hotels in the spotlight as well when it comes to the kind of quarterly performance, Anisha, the brokerages, and then the focus of the budget on tourism.
Yeah, a lot of drivers for IHCL this time around. Of course, the revenue growth was 17%. The big surprise came in on the margin front, wherein the EBITDA jumped up by 23% and the margin profile came in closer to 37%. And the profitability too was higher by 18%. Of course, it was a beat on the operational, and even profitability and revenue were a little higher than the consensus estimate that Bloomberg had shown up. Even if you look at the internals, they are positive. The occupancy rates have improved. It's very close to that 77% mark now. The average revenue per room or ARR is also up around 17%. And the commentary regarding growth is also strong. Of course, it's the domestic and international subsidiaries that kicked in this time, so that really supported the earnings for the company. But going forward, they're talking about a double-digit revenue growth as far as FY25 is concerned. They're on path to open 2 new hotels every month. They're talking about how Ginger is expected to jump at a brand level and maybe hit the revenue profile of over 600 crores. So a lot of those important factors working out, and of course the budget focus as well on tourism, spiritual as well as domestic tourism is something that will augur well. We'll of course be speaking with the management today, so we'll discuss all of these points. But I think, Nikunj, this is something which will lead the analysts to perhaps upgrade their targets a bit more, because the had run up, but they're clearly delivering the numbers as well.
Okay, the sector is doing well, the company is doing well. That theory needs no introduction. I mean, it's something which we pretty much know. The quarter gone by is always a peak quarter. It's got Diwali Darshera. So obviously, there was this huge advantage which was there. The question you would ask yourself is then now what's next for Indian hotels? The current market cap is about $9 billion, $8 billion to be precise. At $8 billion, if you look at the profit estimates of about 1,200 crores for this current financial year and maybe 1,500 crores for next year, are you buying the stock at a very throwaway price, or are you buying the stock at very reasonable price? So I would still say that if you are holding on to Indian hotel, I think just don't sell. Don't sell hotel stocks right now because I think it's a 3 to 5 year cycle. And when the cycle is strong, when capacity addition is not going to be there, I think the stock will do well. That's a big picture. Second, let's come to the valuation part. If you're planning to buy now, please remember you're buying a stock at a P of 50 plus. And if 50 plus, if you're expecting the same compounding is going to continue, that 100 has become 400 and 400 is going to become 800. So no, that's not going to happen. I think the stock now would be a function of earnings compound. Large part of operational surprises, they are behind us. The work in progress for Indian hotels will continue. It's a 3 year cycle now. So I think it's an earnings compounder now rather than a peak compounder, what it has been from the peak of the COVID. So you will make money, but keep your expectations low. Expectations would be in line with earnings estimates, which could be anywhere between 12 to 14% or 15 to 20% on this kind of a large base. And frankly, that's good news looking at how the stock has seen a linear move off late. So don't sell your stock for next couple of years if you own a hotel stock. If you want to buy fresh, keep your expectations low. Don't expect the word magic. Have your reasonable expectations, and then I think you'll have a good night's sleep if you buy the stock.
Hopefully in one of the Taj rooms. Good night's sleep. Okay. Thanks very
You
much.
know, as a shareholder, you actually get coupons.
Yeah.
If you buy Indian hotel stocks, even if you buy one share, you get that one coupon.
Yes.
I don't know if you're aware of it.
Of course I am.
Yeah.
Okay. Thanks very much, Anisha, for giving us those details.
I'll give you a trick. If you buy their subsidiary hotel stocks, no, you also get that coupon.
Oh, okay. Good to
I'm sure you have them all.
Yeah.
I know the ways to get in.
Yeah, you do.
Anything which is free, you know.
All right, let's get a move on then and connect with Jahangir Aziz as well, who's joining in. He's MD and Head Emerging Market Economics Research at JP Morgan. Jahangir, good to have you on board. Thank you for taking time out and joining in. And clearly, the budget being described as judicious, where prudence trumps populism, and how the government has really done the right thing. How would you describe the budget?
So look, on the headline numbers, we expected the budget deficit to be about 5.2 in a pre-budget preview of it. It surprised even us and delivered 5.1. So obviously, we have to laud the government in delivering a very strong consolidation. And in our view, given where its growth is, and you could quibble with the numbers, with the 6% or 7%, FY24 and FY25, you are going to see these 6-7% growth numbers. Disinflation is on track. It is not really where the RBI wants it to be, but it's getting there largely because most of the disinflation is being driven by a normalization of supply chain and because there is a significant amount of export price deflation coming out of China. So we will get there. And if the Fed's cuts somewhere between now and June, we have a June date, but the Fed starts cutting, that gives the RBI ample space to start cutting rates and support the economy. So there was never really any need to provide macroeconomic support at this point in time. Instead, what was really needed was that they focus back on fiscal consolidation just to get India's debt stock stabilizing around the 83-84%, which we think is going to happen, because even if you compare it to pre-pandemic levels, which was at 70%, you're about 15 percentage points higher stock of debt. So it was needed to start consolidating and consolidating early.
Jahangir, you think now from what the finance ministry has done, the action is going to more move towards RBI? We already had, saw what the Fed indicated. You think now that pivot and the cycle turn of when the rate easing is going to begin is going to act as the next big trigger for both equity markets as well as bonds?
Yeah, I mean, look, the government has done its job, right? This was a 0.7% consolidation. And given, the track record of this particular team in North Block, they have actually delivered, year after year. It is not that, they have missed their target. So we can be pretty much sure that, unless something unforeseen happens in the global economy, we will get the 5.2% fiscal deficit done. It has actually brought down total gross borrowing. You add on to it that, with some persuasion, if you can get the state governments to start paring back from the, 3.1, 3.2% to, let's say, closer to 2.7, 2.8%, both of them together now creates the kind of fiscal space that the RBI would have needed if it was to go on a, significant easing cycle. And I think that what is holding the RBI back is simply that, the interest rate differentials with the Fed is still too low for them to do that without, raising concerns about financial stability. So my guess is that, look, the RBI will do a Fed. They are going to say that, enough amount of, progress has been done on inflation, but they still need to see some more data, and they still need to be some more convinced that we are on the right track, and that the government has provided them with this fiscal consolidation, a very credible policy framework within which they can start cutting rates. I don't think they're going to cut rates till the Fed actually does cut rates. But after that, yeah, you could see some reasonable, cuts in RBI's policy.
Quite interesting. Also have to talk about, Jahangir, what's happening within India equity markets. While we're rip-roaring and we're already looking at a fresh all-time high and, eyeing that once again, the fact of the matter is that foreign money has completely eluded India, right? All through 2023, and we're seeing that play out this year so far as well. Do you think purely because of our positioning vis-a-vis the rest of the world, 2024 makes a stronger case for more flows and concentrated ones at that towards emerging markets, and thereby India also benefiting?
Yeah. So that's what we are hoping to see. Obviously, in January, we did not get that kind of flows that we were expecting. And part of the reason was that, you had this exuberance in December where you did see actually significant amount of flows coming into emerging markets, not in Indian equities, but there was significant amount of emerging market flows coming in. But again, questions about whether or not when the Fed will start cutting rate, again, with the March rate cut being pushed back, I think that also, pushes back this rate cut. You really need the Fed to start cutting rates, and you really need, the 10-year rate and the 2-year rate in the US to start sliding down to more normal levels. It is very, very hard to see people putting money in, risk assets outside of their comfort zone, i.e., getting over their home bias. When this cash was paying you about 4.5%, 5% not too long back, and your own equity market was, giving you a significant amount of upside. So I think that, you really require this interest rate differential to start narrowing. Once that happens, we do expect emerging market countries, including India, to see significant amount of portfolio flows, and flows will be returning. And again, what we should keep in mind is that even if you look at the entire, post-pandemic period, if we add up all the flows that have come into emerging markets, there haven't been very much. So people do not own emerging market assets very much. Ownership is very low. Positioning is very low. So I think once that trigger starts, I think you should not be surprised with significant flows coming in.
That seems to solve our problem. Jahangir, great having you on the show today. Thank you so much for taking the time out. Okay, let's move on. Let's, in fact, take a very quick break on that note. When we come back, of course, we've got a whole host of market experts lined up to help you navigate trade today. Back with the market, right? You're now done and dusted with the interim budget. Back to business, back to earnings. So let me welcome on board Lakshmipati Deendayal, the CMD at 5-Star Business Finance, joining in on the show right now. Lakshmipati, great to have you today on ET Now. Thanks for joining in. As I see in your quarterly numbers, your AUM grew by about 43% in Q3. What are your own expectations of what you plan to clock in Q4? FY25, and do you believe that you would have to revisit then the FY24 guidance of 35% growth?
Yeah, good morning and thank you for this. As I'm being keep telling in your channel that opportunity for catering the uncatered segment of this country is large and huge. So 5-Star sweetly fits into that. So having said this, our growth is always going to be robust. So we guided 35% growth for this financial year, and we stick on with that guidance. And hopefully we'll complete better than that for this financial year.
While your AUMs have risen sharply, disbursements have largely remained flat on a sequential basis despite the festive season. Are you seeing any concerns for growth slowdown in any of the pockets?
Nothing. I think there was a little short of disbursement comparing the AUM growth. There was some kind of unseasonal or weathers in two big states for five-star. One is Tamil Nadu and Andhra. You would have seen in the news on the Tamil Nadu getting flooded, and that got impacted in coastal Andhra too. So we had a minimal loss in few days in disbursement there. That is why you see that disbursement was comparing to the last quarter.
All right, morning. And what is the outlook for growth beyond FY24? Is the market opportunity large enough to continue to support such high growth, even on a large base?
Yeah, market opportunity is large, no doubt about that. But there are a few points which is running in our mind. One is this exuberance credit growth, what we see in unsecured small ticket short-term lending, which is a cause of concern for regulator. So we have to see how the regulators are looking lenders in bold and how does they feel. That's an important point, an important call any lender has to take when they look at next financial year. The opportunity is big. As I said, we are catering into an uncatered segment. So there is no issue from an opportunity perspective. So we have to time it well, and we have to be a little cautious when the entire lending space seen by the regulator as very exuberant. So keeping that in mind, we are optimistic, and we maintain our guidance 35% year-on-year growth.
Okay, you're maintaining your guidance. And what about your cost of borrowing? Because that has declined at a time when most companies are experiencing a rise. Is the majorly secured nature of your book giving you some sort of an advantage?
Yes, absolutely. Being a fully secured book, our quality of asset is very good, and capital adequacy is less of 50%. And so that lenders find very comfortable lending to five-star. So as you see from the presentation, our cost of funds have on book have come down from 9.7-ish level to 9.6-ish level. Even though the risk weightage has gone up, a banker lending to NBFC. So that circular hit somewhere in the November month. As we speak, till January end, we were borrowed close to 1,500 crores. Fresh money that's coming from bank to five-star. The cost of fund has not gone up much. The incremental cost of fund was 9.5%. That has gone up to 9.57%. So just 7 bips, even after the impact of the RBI's November month circular.
And, at a time when we're seeing a lot of banks rationing credit, how is it that you're managing your borrowing costs? What's the outlook as well on your net interest margins?
The net interest margin will keep coming down. That's not a concern, because as you keep borrowing more, as I said, the leverage of the company was around the sub 1% last year. We have moved up to sub 1 times last year. We have moved up to 2.2 times this year. So more debt has to be borrowed. So the leverage is there. So that your NIM will get contracted. There's no doubt about it. Our guidance on NIM always was around 14-15% in the steady state. So there will be a contraction in NIM because the borrowal from the banks or the debt borrowal is going to be in the outside. But the outcome, what you have to see, the return on equity, which was less than 16% last year, we were at more than 17% this year. So as your leverage goes up, your return on equity goes up. As your leverage goes up, your net interest margin gets contracted. So there's nothing to be worried about the net interest margin, seeing a slight drop in our Q3 numbers.
Okay, one last question. If you're sounding so confident, and if operationally things are looking up, then can I say this 35% growth for FY25 should be north of at least 40?
Because I lost your voice in the
No, my
last.
voice itself is gone after budget, so please bear with me. Too much of talking.
So you're talking about next 3 years or what?
No,
Get
I'm
the
talking about
last.
next 3 years CAGR. I mean, if you're so confident, then why just stay at 35%? It could easily be 40%, 45% for next 3 years.
So first of all, let us under-promise and over-deliver. That's the way in which we wanted to go. From an opportunity perspective, Nikunj, I clearly with you that Five-Star can do more. But as I said, the regulatory environment has to be also seen in. So that regulators should be comfortable that each and every lender of this country are not exuberant in moving ahead. So keeping those things in mind, we still feel 30-35% for next 3 years. It's a very meaningful growth for Five-Star.
Really appreciate your time. Thank you so very much for joining us. Rahul Chadda is here. And these days, I can ask myself, when suddenly if a person lives in New York is in here, it's a AI avatar, is it deepfake or really there?
No.
In person, not AI or something.
In person with you guys. Sir.
Okay, thumb the table and convince me.
I'm there with you.
Okay, you're there with us. Great. Now I can ask questions. These days in AI world, you don't know what's coming up.
Yeah.
Did you see our budget coverage yesterday?
Yeah, I saw that.
What did you see?
No, I think it is a continuation of what's happened over last 4-5 years, prudent macroeconomic policy, and I think that's where we've, as a country, upped our game. Where, if you see around us, most of the countries in the Western world, they are having high deficits, bond yields are spiking over there. So I think fairly happy with the direction we are heading in.
My question is that if things are looking so great, then why are FIs selling?
Okay. So here what we're talking, Nikunj, is of a 5-7 year outlook, and again that gives a flow to the growth. The reason FIs are selling or have not been buying as much is valuations are not cheap. You look at this quarter earnings, and this has been, I would say, one of the most disappointing quarters in last 1 or 2 years. And these numbers are not going to improve in the March quarter. See what has happened between last quarter.
Because you own HDFC Bank. If you would have been owning other stocks.
No, I'm not talking about specific HDFC Bank or anything
Look at
else.
Titan numbers, look at Inn and Hotels.
No, again, see, those are few, but if you look at broad consumption space, leave aside parts of discretionary.
Actual numbers were bad, you're right.
So broad consumption space, you look at things being soft, basically. And what has happened is last 3-6 months, we've seen all this tightness happening on the unsecured lending also. So you'll see some pressure. But look, within a long structural cycle, you'll have mini cycles. And mini cycles will give good entry points for long-term investors. So we want the dips, we want some bit of a softness so that valuation is correct and you can deploy long-term money here.
Do you think, Rahul, that the fact that this time around there were no populist measures announced in the budget prior to the elections, that was a bit of a miss and that was something that maybe the street and investors across the board were anticipating?
See, that could have given short-term boost to the markets, but then eventually a year later we would have gone back and said, look, the fiscal deficits are high, debt to GDP is kind of a ballooning, and that would have had a pressure on currency. So let's see this whole thing played out between 2009 to 14, where we had huge SOPs for the semi-urban rural economy, but look what happened to the currency. Rupee depreciated from 47 to nearly 65 when the Modi government came in.
Yeah. No, I just wanted to understand your outlook as well then in terms of individual sectors. Looking at the longer term, would it be capex-oriented themes that would take center stage?
Absolutely. I think capex-oriented themes, we've liked banks, and look, as Nikunj was saying, banks have not done well. But look, the pressure on NIMs would be largely behind us in a quarter or two, etc. The system liquidity would kind of adjust itself. You will see rate cuts coming through in the second half, so that's going to be positive. So continue to like banks over there, the infrastructure plays or the industrial is something we like. I think there would be a time sometime in the H2 of this year that one would start looking at these consumption names. These names have not gone anywhere for last 3 years. Let's understand, 3 years back, the country was hit by severe COVID. That impacted huge businesses. For us to come out of that and completely forget the havoc it created on small businesses, on the job creation, I think it's just being a bit stretched. So somewhere, as the time passes, as inflation eases, the consumer resilience would come back, he'd start spending, and that's where some of these sectors look attractive.
But why is it, sorry, that the market is treating banks the way it is pretty much across the board?
So banks were a sector, particularly private banks were a space well owned by FIs. And look, FIs has not been putting large chunks of money, large amount of inflows last years, which have come in small mid-cap funds. And I think that's where, as people venture out of these well-owned names, there has been more momentum. And what we've seen in markets over last 4 or 5 years is that wherever there is momentum, that kind of attracts more money. And that's a self-fulfilling prophecy until it breaks, basically.
My question to you is about this divided view on IT. The old timers would say, we've seen this before. Trust me, we've seen this before. Y2K it happened. It happened in 2008. It happened when SMAC and digital came out. And AI is just an extension of a technology wave which is changing. But IT companies have seen it all. The new, breed is of the view that AI is different. It's going to cut manpower cost, and it's going to have an impact on the way how IT companies, the services companies, will do business.
So you're right, but look, what is going to happen is it is a matter of time frame. If you got a 5-year time frame, these companies would emerge out victorious, like the way they've done in the past. If the time frame is 1 or 2 years, 1 or 2 years is where the readjustment is happening. You look at what the Google, Facebooks and all these guys are doing. They're laying off 15,000-20,000 workers, and they're hiring skill sets in a new AI relevant space. So I think that is what is going to happen with the Indian IT services company also. They will go through this readjustment phase where they reorient, retrain their teams for the skills of future.
Where is it that in the current market you think there is pockets of exuberance and one needs to at least either not deploy fresh money there, even though that they may be looking attractive, or at least book profits?
I think some of these small mid caps, names which have gone up multiple times in particularly last 6 months, you don't have to do much. Just look at names which are up more than 40-50% last 6 months. And these are not really the great business models. There's a fair bit of a frothiness. I think those are the names. Everybody knows what those names are. One can easily take some money off the table.
Where is it that you see the next big risk maybe emerging? Do you think that it will be largely driven by global factors versus something happening back home?
I think what happens is globally also markets were very exuberant about rate cuts happening. If you see how the narratives change in last 3-4 weeks, those rate cuts have got pushed back, and that is something which is going to happen. But look, those pullbacks are going to be kind of a shallow pullbacks. Those are not going to be deep pullbacks because, as we've discussed before, you've not seen large scale excesses happen globally. Where you had excesses was overinvestment was largely China. So China is going through its period of digesting those excesses, those course correction, etc.
Okay, and give us a sense as to what the outlook is then in terms of your medium-term view for the markets. You continue to remain positive. Will it be earnings growth that will drive the long-term trajectory? Are the macros looking fairly robust?
So again, near-term view is, look, things are going to be soft and markets may be range-bound or slightly down. But if you take this time frame beyond 1 year, yes, we're positive. Because whatever the government's done on fiscal prudence, on these infrastructures, etc., that is going to give a flow to the growth. So globally, as we see things being soft, we're going to stand out in terms of 5-6% plus GDP growth. Nominal GDP growth would then be about a 10% plus. And I think that's where, again, these businesses will bounce back. The consumer will go through its own cycle. Being in a shell, they'll come out and spend money somewhere later this year, next year. So I think we remain positive on the names we've liked before: financials, industrials, consumption, real estate, hotels. I mean, there's a lot to pick in India.
Rahul, from Hong Kong, you're now in New York. Tell us what's the chatter around, the US presidential elections, because that's going to be the big event 2024.
Yeah. So I think if you look at what is happening in US presidential elections, is we've seen in recent months Trump come as a serious contender. There are talks that, okay, he may come and win also. So I think that gets its own policy unpredictability from a world perspective. Look, the US has done exceptionally well because there was a policy stability, and we all should appreciate what is happening in India because that gives policy stability. If you have policy stability, businesses are willing to invest for the long term, and I think that's the challenge US faces come next year, that there is going to be this whipsaw in terms of policy making, in terms of the noise which came. So businesses may hold back investments, and I think that's where you will see more money coming to a country like India, more from a FDI, FI perspective, where you have strong macroeconomic policy making, where you have consistency of policy, and I think that's where the PLI, the 1 lakh crore which has come for R&D, etc. All those are small positive steps.
Okay, Rahul, great having you in the studios. You have a good India stay. Thanks for joining
Thanks for joining.
Thanks for having me.
Okay, let's move on and let's get our focus back to earnings. We've got Ashish Kataria, the director at Roka Buildcon, joining in to talk about how their quarterly performance was. Ashish, hi, good to have you in ET now. Just firstly wanted to get in a sense about, a takeaway from the budget. The FY25 budget seems to be slight bit of a negative surprise, if you will, for NHAI allocation within roads, which is just up almost 1%. What's your take on the same, and is the budgeted capex spend in line with your expectations?
Yes, I concur with your view that the allocation on NHI is not what should have been, with a huge backlog of projects that is already there. But the silver lining here is that there is a good allocation and a good policy drive on the railways front. That's an area that Ashoka Buildcon is pretty well entrenched. We do track signaling, electrification, everything. So yes, there is a silver lining on some other sectors, which will hopefully save the sector.
Right. But tell me, what kind of order inflows are you expecting for FY25?
So we are expecting to amass at least another 8 to 9,000 crore rupees worth of orders in the year to come. And we've already bagged some orders in the highway sector. Some of them are with the state government. We recently got an order with CIDCO and other state governments. We bagged a few orders in Maharashtra, sizable ones. So yes, we should be happy with an 8 to 9,000 crore order addition. International is also an area where we see some promise. We have a robust bidding pipeline on railways, highways, and international. So that's what should bring the business for us.
Okay, morning. I just wanted to also understand the outlook in terms of your order book. Where does that currently stand, and what are you targeting for the year ahead in terms of order inflows? Anything major in the pipeline?
Yes, so order book currently, Q2 order book, we closed at around 15,000 crores. As I said, recently we've added some projects some orders on the power side and some bridges and highways that got added. So we are expecting to, look at least 20% year-on-year growth on our revenue numbers.
What about the outlook in terms of the link road for Mopa Airport? Every time I travel, it seems like there's a lot of progress. So the commissioning of that, all of it on track?
Yes, that's a project which should bring in a lot of accolades for the company. It's technically challenging, engineering-wise, it's a very challenging project. And this project is being completed on schedule, ahead of schedule rather. And it has been a big confidence booster to the entire organization. In such a short time, in a state like Goa with the rainfall what it is there, we've been able to really complete this job. And by the time you go on your next Goa vacation, you'll go on the new highway.
Looking forward to that already. But tell me, how do you plan to use the proceeds of this stake sale that you've done in Unison? And is it going to be completely deployed for debt reduction?
Yes. So we sold Unison at a little above 562 crores, and ABL is getting 51% of that. And this will go towards reducing debt.
All right. Thanks so much for taking time out. Wishing you all the very best for the coming quarters. All right. Let's take it then across to Naresh, who's standing by with us. And Naresh, just come in then on levels that you're tracking on some of the heavyweight financial names. What is it that you'd be watching out for on the Nifty Bank as well as some of the top financials?
So first off, starting off with Nifty Bank. Now, if you look at Nifty Bank, that has been the major underperformer compared to the rest of the market, even if you take Nifty or any other index. The only good case is that the fact that it has bounced back from the 200-day moving average. And we've seen a small bounce and a recovery, but it still is far away from the highs where it was at 48,500 plus. Now, the price point I'll be watching out for, the big down day tick which we got, that's the price point where we had 46,500 as a resistance. If it can sustain above 46,500, that would be an indication that the momentum is shifting. In the heavyweights banking space, the first one which looks pretty promising is SBI. We've seen the whole PSU basket of banking do really well, whether it is a IOB or a larger bank like Bank of India also. But SBI has still been struggling to make that breakout move. Post numbers could be that trigger. 650, 660 is the short-term resistance. If it crosses 660, opens up a target price of 750. Same way, ICICI Bank has been a stock which has been consolidating around the 1,020 mark. If it sustains about 1,050, that would be a breakout on that one as well.
Okay, there you have it. That's the view coming in on some of the frontline banks. But in yesterday's trade, L&T continued to underperform. Kunal, give us a sense as to what exactly the chart reading is. Could it go down further from these levels?
I think it's a good time to start accumulating L&T because the stock doesn't have too much of a high beta nature. In the last 2-3 years, we've seen a dramatic change for L&T. The moment the stock had broken past about 2,000 levels and then slowly and steadily moved about 200 DMA. One of the only phenomena which we've seen being a lot more recurrent phenomena for L&T is the stock coming back towards its 50-day moving average as part of a mean reversion or a corrective phase, spending some time over there and then managing to pick up pace in terms of rally or rather the trends picking up for L&T. The stock yesterday managed to break below the 50-day moving average, which means that possibly the stock may correct by another 40-50 rupees or 2-3% odd. But I think closer to 3350 odd levels, 3300 mark, I think that's a very good zone to try and go for a contra buy on L&T. Because of this recurrent phenomenon the stock has shown over the last 1.5 odd year of the price rally. So I would probably take any major correction or even a 2%, 3% correction on L&T as a very good buying opportunity for the stock.
Well, cement, that really seems to be the flavor of late. And I'm not talking about India Cement. That may have cracked hard, but ACC, Ambuja, Shree Cement, all those have been earnings reaction, a very strong move in the entire sector. Naresh, any trading opportunity here within the cement names?
So in the cement names, the broader names look more exciting. We've seen sharp breakout moves happening in a Birla Corporation. The stock has given a short-term breakout as well as getting close to the highs of 2021. So that's a momentum stock which could do well, go towards the 2000 mark. Then I would same way look at the smaller names like a Dalmia Bharat Cement, which is interesting because that's been in a very tight range of 2100 to 2400 and could break out going forward. So the larger names have already done well, but we are seeing much better charts on the mid cap and small cap cement names. So that is where I would go with a Dalmia Bharat and the other name.
Lots of other stocks which are going to be in focus today. Well, of course, today you've got Tata Motors, Indigo, both reporting their numbers. But in terms of individual movers as well, I want to see what Paytm would be up to. Yesterday, just the management heard the, the conference call. We played a soundbite of that earlier today. But Paytm was locked in lower circuit, 20%. Let's see whether the stock sees another deep dive today, or is there any rebound that you see on the stock. Bata was another critical earning that the street was looking out for. Although there's been a bit of a margin squeeze there, the margins have come in at 20% versus a comparable of 23%. And the EBITDA as well has been lower by 11.5%. So Bata is going to be another one to look out for today. For Indian hotels, no surprises here. It's been the best ever quarter, EBITDA bump up of about 22.6%. So lots of other stocks which are in focus this morning. But yesterday it was all about autos. So let me quickly take it across to Shrishti, find out how the Motown sales have performed for the month of January, Shrishti. So the standout segments this time in the month of January are the passenger vehicle and the two-wheeler segment, because for the passenger vehicle segment, a bit of a surprising sales number coming in from the likes of M&M, Maruti as well as Tata Motors, wherein we did tell our viewers that sequentially there could be an uptick after a weak December, because the key focus area and back in the month of December was to lower down the inventory levels. The sales could catch up, but the numbers are better than expected. Almost double-digit growth, that is 23 to 45% in this range of growth on a month-on-month basis is what we have seen for all of these three companies. But coming to two-wheeler segment, herein the numbers were expected to be good on the back of the continuation of the sales momentum post the festive season as well. So all the companies have delivered good set of numbers, but the standout numbers I will tell is coming in from Eicher Motors Royal Enfield, because versus our expectation of 71,200 units, the company has reported 76,187 units, and that's a jump of 20% on a month-on-month basis. Coming to the commercial vehicle segment, this segment has actually disappointed, but we did highlight that before the budget and the election period, there's expected to be a little bit of slowdown in the commercial vehicle space, but the numbers are disappointing versus our estimates as well. 2 to 12% of decline on a month-on-month basis is what we have seen for all the three listed companies, Eicher Motors, VECV, Tata Motors, as well as Ashok Leyland. And lastly, from the tractor sales, Escorts did mention that the delay in the Rabi sowing has impacted the sales number, and hence the numbers were weaker than expected. But that's a jump of 36% on a month-on-month basis, because December was a weaker month. And for M&M tractors, the sales were almost in line versus our estimates, 25% uptick on the month-on-month basis. So if we have to keep our eyes on, then passenger vehicle and two-wheeler segment could be the star performance today.
Right. In fact, Srishti, you also looked at the Tata Motors third quarter earnings report. Talk to us about what exactly happened there.
So actually, good set of numbers expected from Tata Motors, and the key highlight will be the JLR EBIT margin. So we will have our eyes on, because we are expecting even an improvement on the JLR EBIT margin on a quarter-on-quarter basis. 7.4% is the expectation this time around, and the key driver will be the volume push. 4% growth on a quarter-on-quarter basis is what we have seen on the volume figure, and that's expected to give a push. India business volumes were actually a mixed bag, almost a flattish volume growth for the passenger vehicle segment, but the commercial vehicle was a drag. 9% volume decline is what we have seen. So not much expectation from the India business, but JLR could really take it higher. On the number front, we are expecting a flattish sort of a growth on a quarter-on-quarter basis on the top line. Coming to the EBITDA number, 3% uptick is what we are expecting, and the consolidated margins expected to improve to 13.3% versus 13.1% in Q2. Other than that, the profit is expected at 160 crores. That will be a jump of 23% on a quarter-on-quarter basis. But the key to watch will be, first, I told you that JLR EBIT margin, how these numbers pan out to be, the demand outlook, as well as JLR cash flow numbers is also important to track, because surprisingly, this time in the quarterly update, the company didn't mention about the cash flow numbers. So how the cash flow numbers and the guidance going ahead pans out to be, we will have our eyes on. But the stock has already seen a significant run up. So let's see how the numbers come out and the stock reaction as well. Back to you.
Thanks very much for that, Srishti. So that was all about the Motown, but Sanjiv Bhasin is here with us. Sanjiv, now after almost 24 hours of the budget, of the union budget, however vote on account it might be, people are now getting to terms that yes, it was indeed a decent budget. They were not here to please the masses. It is a prudent, fiscally very prudent budget. So, and probably that's why you're looking at a big bump up as far as the indicative number is concerned of the GIFT Nifty. Do you expect new highs anytime soon now, just 300 points away?
Yeah, good morning, Ajay.
Morning.
Not even 24 hours. 11 o'clock will be 24 hours, and markets are in fine fettle. The Fed is on easing. The Fed bond yields are down to 3.85. If you recollect 2 days back, I've been telling you that. And I think the missed out feeling now will come more to the fore, because generally people expected that after the budget there will be some sort of weakness which will creep in. I think Indian markets are very resilient. You've seen the mid caps outperform. PSUs are leading from the front, and I think banks will now join the rally. You had almost 30,000 crore of selling of HDFC Bank, which was the key barometer and which dragged down the bank index, bank Nifty. I think that is now starting to catch up. I would expect large cap banks, FMCG, select auto stocks to continue to outperform. So yes, very much new highs are on the card, Ajay, whether they come today, tomorrow, or the next week. Today I'm saying this because there is a lot of pessimism and some sort of value buying stroke short covering can also trigger a 200, 300 point rally on the Nifty.
One quick follow-up on PSU banks. That was the area of the market, BOB, PNB, your old-time favorite SBI was running away because of the yields, collapsing almost 10 basis point. Do you see more juice in PSU banks near term?
Well, new highs are here to stay. PNB, Can Bank, one of my top picks and in my portfolio as a disclosure, Union Bank. I think Dhanlakshmi Bank will be the next performer. But Ajay, if something now, I think ICICI numbers are very sweet. I think HDFC itself at 2.5 times price to book against the IRDA, which is at 4.5, gives you a lot of thought to ponder. That do you want to buy the miss buying the fifth largest bank in the world just because FI is over on it? And I think it is a very prudent time to buy that. Along with that, I think there is a lot of bonhomie on milk dairy products. Nestle has been will be a very big outperformer after the results, and I think there are enough pockets which can take this market higher.
Hi Sanjiv, morning. Let's get a sense from you as to how you're reading into IHCL's performance and how that entire cluster of stocks is expected to do. Indian Hotels is pretty confident about double-digit revenue growth down the line, their new businesses as well driving profitability. Will it continue to remain the leader in the pack?
Yeah, good morning. Avan, there is no running away from the fact, but Avan at 500, there is not that much of room to get easy money. I mean, today it will open at new highs, but like I said, if you are into Indian Hotel, then stay put. Fresh buys at this level, at the stock trading at quite multiples will not be easy, and maybe the best money has been made. Now, yes, we are aware that average room rates are now hitting all-time highs, and there is still room to go up, which tells you that the Indian spender and the middle class income is now migrating towards more aspirations of five-star hotels and so on. So continue to be upbeat. This is in our portfolio, and we are not adding, but we don't want to leave our position in this stock. As an advice to new investors, do your scouting, do your diligence. But now the easy money will not be so easy because good news is already getting priced in.
Point. Nuresh, I want to play a small slice of a discussion we had with the railway minister. My colleague in Delhi had it, and then I'll come back and discuss Amber Enterprises with you. It was down 6% till the speech was going on and ended higher by 2%, almost a 7-8% reversal in Amber Enterprises. I want to do a check with you on the charts, but before that, let's play a small slice of the conversation because very important point coming in. 40,000 bogies, traditional bogies, will be standardized, and the new the railway standards, air condition, also swanky kind of a bogies will be converted. So watch out for that special chat we had.
India has come out from being fragile 5 economies to top 5 economies. That is the transformation which has happened in the last 10 years. It has been a period of inclusive growth. People who were left out of the development process, they have all been brought into the mainstream, whether it is through Ujjwala scheme, whether it is through Pradhan Mantri Garib Kalyan Anna Yojana, whether it is through the Pradhan Mantri Awas Yojana. Multiple number of programs have been structured for bringing the people who were marginalized, bringing them into the mainstream. Simultaneously, Prime Minister has focused on the creation of physical, digital and social infrastructure. Whether it is ports, airports, railway lines, highways, transmission lines, everywhere you can see a complete transformation. On digital side, the way the number of towers have grown multiple times, the optical fiber cables have been laid, lakhs of kilometers, both physical and digital, and social infrastructure. Number of IITs have increased multifold, New aims have been started. New medical colleges have started. It's a very holistic program that Prime Minister has laid. And finally,
Okay, so Amber Enterprises is in focus right now because it is forayed big time as far as railway air conditioning is concerned. Just a while back, the management was there on our channel to talk about it. Yesterday, the stock was actually, this is the pre-open rate which is coming in 45.35. Look at the last 1 month chart. Nuresh, what do the charts tell you? Does it have more juice, or one needs to be careful?
So it becomes a buy on dips. It's just that the risk reward is not great. If you look at it, the stock made a bottom of sub 2000 rupees in May. The stock is up at 4500. Then if we go back to 2022, this is where the stock was at 3800, 4000 levels. And that is where we saw a correction of almost 50%. We've crossed above those levels. That was a resistance for whole of 2021. So 4000 now becomes a base. So you want to buy it on dips to 4400 to 4200. So that a stop loss at 4000 makes sense in terms of risk reward. So the momentum is strong. Finally, the stock has been able to recover those highs of 2021. So out here would be buy on dips rather than at current prices.
One last word before we let you go, Sanjeev, is on L&T. Came out with a decent set of numbers, but stock had run up. But they've guided margin expansion and very strong order inflow for Q4, as clearly as they could get in their con call. Are you comfortable getting into L&T at these levels, Sanjeev?
Well, Ajay, we own L&T from much lower levels, and we thought that the recent run-up was more in excess of doing, but that's plateauing of this. If you recall, whenever L&T comes out with results, the best is priced in before that, and after results, there is generally a reaction. I would definitely buy. Look, it is the best player as far as hydrocarbon, as far as electrical, as far as engineering, and it's coming out with 12-13% margin, which was never there. It was always in high single digits. I think their order book, their pedigree of management, their execution, and now more, more fire in the belly of execution will add to that kitty. Their Middle East businesses are also doing extremely well. So I would say this is the perfect time to do a SIP. Use this volatility maybe for the next 4 weeks to add this stock.
Okay, thanks very much, Sanjeev, for sharing with us your thoughts. Good to have you on board as always. Well, time for some khabar on D Street. APL Apollo Tubes, that's going to be in the spotlight. The company is planning to expand their warehouses internationally and are focusing on increasing the Dubai plant capacity. Sharad's got all the details. Sharad?
The cover on the street for APL Apollo Tubes is that the company is expected to set up warehouses in US and Australia. They're targeting the cities initially for Houston, which is in US, while Melbourne is there for Australia. And also the company is scouting for more export-oriented geographies as well. And as per channel checks, the January exports have already risen by 50%. And from the Dubai plant itself, they're likely to do 8,000 tons in the month of January. Now, the target itself is about to hit the 30,000 tons mark by the end of March, and also the Dubai plant capacity is expected to increase by almost 40%. Now, looking at the stock itself, the Q3 numbers have been largely weak to mixed set of numbers, but the company has maintained its guidance going ahead. And also importantly, the management has claimed that the export size for the total market is roughly 30 million tons. So that is something which gives a strong headway for growth for the company when it comes to the exports. But the stock has been on a correction since August 2023. The stock is down 16%.
Yes, it sure has been, and APL Apollo is once again in focus. On that note, let me get you some mid-cap trading ideas as well, and let's find out what our chartists have on board with them. Kunal, what's your mid-cap list?
Well, it's a buy on Bector Foods, the stock which has fallen down from, I think, 1350, 1400 towards the point when the stock was almost at 1100, 1150 mark. So I think now the stock seems to be forming a major bottom. There's been a time-wise consolidation and a classical reversion to the mean for the stock. Volumes coming back, Bollinger Bands extremely narrow for Bector Foods. All of that are ingredients for a strong breakout possibility for the stock over the near term. I would suggest a buy with a target of at least 8 to 9% on the upside, so 1300 as a target, and stoppers could be kept at 1155.
Right. Nuresh, what about your mid-cap ideas?
So continue to like Container Corporation. The stock, after making that base from 830, has now given a flag breakout. Very strong volumes in the last 3-4 sessions, setting up for a move into a new all-time high today. expecting follow-up towards 1000, 1050 in the short term, stop loss at 910 now.
All right. So yesterday there was a 20% downtick, major delivery-based selling as far as Paytm goes. Let's see how it goes in today's session. Another 20% is what the indicative rates are telling us. But let's hear out what exactly is the view coming in on Paytm now.
See, the crux of the business model has changed, right? And if the crux of the business model has to change, they don't have to take a detour. They will have to reimagine themselves. And that reimagination will come at a cost. It will come at a cost of, it will come at a cost of what will happen to, it will come at a cost of revenue. It will come at a cost of operating cost, and it will also come at a cost of time when they'll have to come up with the new architecture. Look, this is not the end of the road for Paytm. I'm sure they will come out. But what the assumptions were as to where the franchise was moving, how the payment business is going to move, how the wallet business was evolving, what will happen to the insurance business, all that changes. Paytm was not cheap. Even at the current market cap, just look at the market cap. I mean, the market cap for Paytm is not very cheap. See, there are a lot of folks who bought actually into Paytm because of hope trade. Okay, you know, the fintech space is improving, Paytm is improving, it's a market leader, it's a great brand. A lot of those sort of weak hands which bought into Paytm after the recent rise, they would be tempted now to get out. And then there is continuous supply which keeps on coming from anchor investor. So I'm not saying it's end of the road, but the point we just want to bring out for our viewers is that there is going to be more supply than demand in the near term, and you should not be tempted to buy Paytm even if it goes down 25 or 30% from here. It is better to buy Paytm when you get clarity as to how are they likely to re-architecture themselves, and also ask yourself this very big question. While Paytm may be coming out, Anisha, and saying that, look, we don't know why, the regulator does nothing without a why. I mean, there must be a backstory which we are not aware of, or maybe Reserve Bank of India does not want to share, but there is never a why when it comes to a regulatory regime, because if regulator has given you permission to do it, there is a check and balance and a framework which you have to bring, and if you're not following it, then it's a cross. So I want to know the why before I decide what is next for Paytm, and for me that is a bit of a sandook right now, which I don't have the digital lock key for.
Already indicating of another downtick of 20% in the pre-open rates itself, and considering stock immediately opened and went into lower circuits, I don't think many sellers really got a chance. So maybe you'll see consistent lower circuits on Paytm. But what's Indian Hotels up to? That should be going good, as should be the case with the TVS Motors as well, with Abbott, wherein the numbers have been strong, Minda Corp, the numbers have been strong. Actually, it's a long list. So let's quickly tell you what the index strategies are coming in from both of our experts, Kunal as well as Naresh. And here's what they're predicting in terms of the Nifty call. It's a hold from Naresh, and Kunal is recommending buying Nifty this morning, and pretty much a similar call for the Nifty Bank as well, wherein Naresh is recommending a hold and a buy coming in from Kunal. Just 7 seconds to go before we hit the opening bell for the day after the interim budget, and it seems like we're headed in for a mildly positive start actually. About a 0.5% uptick is what was indicative in the pre-open rates itself, and that's exactly how we've started off. 0.5% higher, 21,800 now for the Nifty spot, and the futures are already inching higher towards that 22,000 mark. But very quickly, what is Paytm up to? Let's bring up that stock. That's been the most news-based, and that's where you've got a queue of sellers really down again 20%. 487 is where that stock is right now. So it's been opening at lower circuits itself for the last 2 consecutive sessions. What are some of the other names up to? There were a lot of earnings reactions. Let's start off then with IHCL and what that stock has been doing right now in trade. I can see some positive ticks coming in, 500 plus levels, 3% higher for IHCL as we speak right now. There's Abbott also. Good numbers coming in there, EBITDA jump up of over 24%, margins have expanded to 27%. Abbott is the other one which will come up for you on your screens. MGL, which is looking to acquire that 100% stake in Unison Enviro for 562 odd crore rupees. That's the other stock which is in focus. If you can just bring up Abbott as well for you. Good numbers from Minda Corp, GMM Pfaudler. Remember, these are very high HNI concentrated stocks. And of course, Motown has come out with a healthy report cards so far for January. You saw that big bump up on Maruti yesterday. Hero MotoCorp, the Jan sales have come in higher, 21.6%. For TVS Motors, an uptick of 23%. Exports as well have seen an uptick of 22%. So most of these auto stocks are seeing a follow-through come by from yesterday's price action. That's not quite the case for Eicher Motors though. Royal Enfield sales have been down 2%. Emphasis, weak numbers there. The constant currency revenue growth is below the street estimates. Margins as well have seen a slip come by. Bata as well, poor performance there. Indus Tower, wherein there has been that sizable block deal. KKR, CPP have both been sellers. Sonata Software, City Union Bank, they've all had a weak earnings report. Ajay, you can see that play out on the stocks. Ajay, anything in specific that you're spotting?
Well, the shoe bite in Bata is quite surprising actually. One would have thought that the numbers would start improving. Pull up Adani Ports. Adani Port came out with a number which appeared to be a slight on the weaker side to the brokerage community in general, but many are missing out that their margins are actually heading above the 90% mark. Adani Ports is up by almost 4%. PB Fintech will also come up on your screen. Very important one. Yesterday, one of the most markiest names in the entire emerging market basket have been a big buyer in. Capital International was a big buyer in PP Fintech. The stock is lower, but we'll keep that on your radar. Let's also get you some opening trades. The first trade which is coming on